Joining me now is Alexander Scanlon. He is the founder, CEO, and president of Barton Gold. Great to see you.
Thank you for having us.
Now, we talked a while ago, but we want to refresh people or remind people, in case they didn't see it, about the Barton Gold story. So you're a pure play explorer developer in South Australia, and you've got a goal of being the biggest independent producer in 5 years or so in that region. So refresh everybody on what you're doing.
Yeah, look, the high level story for Barton Gold is that we focused on South Australia because it holds about 25% of Australia's known gold resources. It only represents about 2.5% of annual production. So most investment in a modern sense has gone into copper development in the state. That's quite literally the IOCG belt on the other side of the highway from us. We've consolidated a gold district that's got about 130-year history, 2 different gold rushes. And so we are pure play gold, pure play South Australia. We are focused on large-scale open pittable mineralization. You know, we see that as being very efficient. It's cheaper, easier, and safer to find, develop, and operate. And we also own the only gold mill in the region. So we've built here by consolidating essentially the majority of all significant historical assets. We've put together 5,000 square meters. We've got about a 1.1 million ounce resource base. That's a starting point for us. And we've got a gold mill, which allows us to leverage not only growth into low cost, low risk operations, but also to look at consolidating the region more and more over time.
Now, your most advanced project is Tunkillia, and you've completed drilling there at the 223 deposit and Area 51 as well. You've identified new zones and extensions at 223. So what are some of the highlights from that as you approach an expected updated resource sometime in April, I believe?
Yeah, look, actually, when we last spoke, I think I was out on site and we were going through this drilling program. And what we did with the Tunkillia project is basically, and some of this isn't rocket science per se, right? So when we acquired that asset, it was a 558,000 ounce resource. And then we grew it before doing our IPO, so we grew it to about 965,000 ounces. But the majority, I mean sort of 95% of the drilling that was on that deposit, that 223 deposit, was done at a US dollar gold price of below $500 an ounce. So this was between 1996 and 2005. So there's really artificially restricted search domain there in terms of depth. You can only drill so deep if gold is only worth so much. So for us, the way that we had modeled this in 2020 when we upgraded the resource was we said, well, we believe quite reasonably that there will be extensions of this same mineralization to depth, and this is very broad mineralization. So this is 20, 30, 40, 50 meters thick. It carries for kilometers. But as well, we believed that there were probably replicas of these gold zones sort of hiding in the shadows in untested areas. So we drilled down the structures, and we also drilled through what was considered previously to be the footwall, or the sort of containing footwall of that mineralization. And sure enough, when we went through this Mayfic dike, there was gold, a sort of gold shadow on the backside of the dike. And we kept going and we hit new gold zones. So these are 10, 20, 30 meter thick intercepts, both down the existing structures and new structures. So that's really kind of a very strong validation of our thesis for that 223 deposit. But then, of course, it's around that deposit where we're also saying, well, here's a repeat of mineralization. So that is really just laying the buffet table, if you will, for where we think are multiple stages of growth in the vicinity of that deposit. And then we've got the next 20 to 25 kilometers of the shear to build out on as well.
And then you've got Tarcoola, and you're going to start drilling in Q2. You've identified 12 structures there, and you think there's the potential ultimately for multiple open pits.
Correct. Yeah. So we bought an existing open pit that was there, and this pit was mineralization that was known going back to the late 2000s. And what it was a small modeled mineral resource of high grade open pittable mineralization. And a previous developer got in there and essentially mined the soup bowl, if you will. So they knew what was there, but all of their grade control drilling and everything was just focused on mining what they knew was there. And they didn't actually drill extensions to depth, and they didn't drill extensions to strike. They were sort of capital constrained. So, you know, this happens. We see that this is an inefficiency that happens quite frequently. The pit was producing a great amount of cash flow, and they weren't allowed to reinvest. So we drilled beneath that pit and found about 200 meter depth extensions, and the pit itself is only 70 meters deep. And we also found an entirely new gold zone sitting right behind the pit wall. So it's something that we can immediately go into, but that's sort of indicative of the bigger picture. And the bigger picture is that on that mining lease itself, we think there'd be maybe multiple repeats of that pit. So the potential to have 2 or 3 or 4 50 to 150,000 ounce high grade open pits. And that pit was producing 3.8 grams per ton in 2018 on average. And then as you step out to those new structures, across the sort of 10 kilometers to the west, we found a dozen or more parallel and cross-cutting gold structures, or I should say new structures, that are analogous to the structure which created that pit. And actually, they've never been mapped before. They've never been drill tested, except for one area where 2 structures come together. AngloGold drilled a hole there in 1997, and they got 16 meters at around 3.5 grams per ton from surface. Now, September 97, you don't follow it up because the gold price is $300 and falling. And they also didn't have that regional structural context. They had a really interesting geochemical signature. Now we know that where they aim that drill hole, you have 2 structures pointing right at it. So the idea is that this year we'll get out, and we're sort of doing an aggressive regional view right now. We'll get out and we'll sort of drill test some of our favoritist discovery targets to see if we might not have a cluster of potential high-grade open pits, but a cluster of clusters.
And Alex, just shifting gears slightly, you've said that Capricorn Metals are your heroes in terms of strategy and execution, and how they brought Karlawinda to production. So what is it about their approach that you want to emulate?
Like the Capricorn Metals story is just a phenomenal story, right? So in Australia, we tend to think of gold mining as high-grade, deep underground gold mining. And Australian mining contractors are very good at complex underground operations. But underground operations come with a lot of risk. They come with a lot of additional expense. They're more expensive and harder and less safe to explore for and develop. And when you look at around the world, the most efficient operations tend to be big bulk open pit style operations, right? So Capricorn bought a project called Karlawinda back in 2015. It was a 650,000 ounce resource at 1.1 gram. They grew it to 900 and 1.1, 1.3, 1.5 million ounces. And then they focused on large bulk open pit operations with a essentially high efficiency of processing volume in a large open pit operation. Fast forward today, they are now in operations. They've been in fully commissioned operations now for I think close to 18 months. They have a 2.3 million ounce resource at 0.7 grams per ton. They're mining a head grade of 0.9 gram per ton, and they are today Australia's lowest cost gold producer. So their all-in sustaining cost is around $1,200 per ounce Australian, somewhere between $800 and $850 US all in. And it really is just a ringing example of the efficiencies of volume and scale, right? So volumetric efficiencies in mining and processing are nonlinear. And that really has given us, I should say, this is not the first time that team did that. That team developed the Mount Rawdon asset, which is now owned by Evolution. They developed the Duketon asset owned by Regis Resources. So time and again, these guys have really laid this track out. And so we are essentially have a hero in the market who've made a case study for exactly the type of asset that we have. And we're just following the steps that they followed. And it's really great, obviously, to have that sort of pre-baked recipe. So we are going to grow our resources, we're going to grow them again, and we're going to grow them again by the end of the year. And we're going to start thinking about developing exactly the same way that they did for our large scale. And then we just bring forward stage 1, put some high grade from Tarcoola through our existing mill, and we can cross the drawbridge into operations for, measured in the millions of dollars as opposed to the hundreds of millions of dollars. And then just focus on expansion into that stage 2. Simple, technically simple, easy to operate, efficient open pit, and that's where we're targeting a step up to 150,000 ounces per annum.
Well, shareholders will love it if you can replicate that model, and we'll be watching for sure. Thanks for the update.
Well, thank you for having us.
Okay, Alex Scanlon, he is the founder of Barton Gold.